Enron. It was a name synonymous with success, innovation, and boundless potential. But behind the gleaming facade of corporate accomplishment lurked a dark secret. This wasn't a story about energy, it was about greed and deception. How did Enron rise to such dazzling heights? How did its executives create the illusion of success while the company was rotting from within? The story of Enron is a cautionary tale, a stark reminder that even the most powerful corporations are not invincible. Enron's journey began in the 1980s, a time of deregulation in the energy industry. The company, under the leadership of CEO Kenneth Lay, capitalized on these changes. They grew rapidly, expanding from natural gas pipelines into areas like energy trading and broadband. Enron was hailed as a pioneer, a visionary company leading the way in the new energy economy. But this success was largely a mirage, masked by a complex web of accounting tricks and shady business practices. It was a house of cards, destined to collapse. At the heart of the Enron scandal were three key figures: Kenneth Lay, Jeffrey Skilling, and Andrew Fastow. These men were the architects of Enron's downfall. Lay fostered a culture of risk-taking and aggressive earnings growth. Skilling pushed for mark-to-market accounting, booking future profits as current earnings. Fastow, Enron's CFO, masterminded the complex web of special-purpose entities to hide debt and inflate earnings. These entities were essentially shell companies, designed to keep Enron's true financial condition hidden. Together, they created a facade of success while the company was rotting from within. Enron's deceptive practices were built on two main pillars: mark-to-market accounting and the use of special-purpose entities. Mark-to-market accounting allowed Enron to book potential future profits as current earnings. They were inflating their earnings based on highly speculative projections. The special-purpose entities, or SPEs, were even more insidious. These off-balance sheet structures allowed Enron to hide billions of dollars in debt and losses. Enron would transfer assets to these SPEs and then use those assets as collateral for loans. It was accounting alchemy at its worst. Empowered by their illusory profits and hidden debts, Enron engaged in increasingly risky and unethical behavior. They became major players in energy trading, using complex derivatives to bet on future energy prices. Enron's traders often crossed the line, engaging in practices that manipulated energy markets and harmed consumers. One notorious example was the Enron loophole, a provision that exempted certain energy trading practices from regulatory oversight. Enron used this newfound freedom to engage in practices that artificially inflated energy prices, particularly in California. Enron's traders were caught on tape boasting about how they were stealing from California. This wasn't just bad business, it was morally reprehensible. Please subscribe to our channel and like the video. It only takes a second and helps us a lot to keep bringing you these business stories and developing the channel. As Enron's house of cards grew taller, cracks began to appear. Sharon Watkins, a vice president at Enron, sent a memo to Kenneth Lay in August 2001, warning him about the company's accounting irregularities. Watkins became one of the most prominent whistleblowers in corporate history. Her warnings, initially ignored by Lay and other top executives, eventually reached regulators and journalists. The SEC launched a formal investigation into Enron in October 2001. The media began to dig deeper into Enron's finances, uncovering more evidence of fraud and deception. The game was up. The SEC investigation and growing media scrutiny sent Enron into a tailspin. Investors began to panic. Enron's stock price plummeted from over $90 per share to less than $1 by the end of 2001. The company was hemorrhaging cash and facing a liquidity crisis. On December 2, 2001, Enron filed for bankruptcy, becoming one of the largest corporate bankruptcies in American history. Thousands of employees lost their jobs and retirement savings. Investors lost billions of dollars. The collapse shook public confidence in corporate America, exposing the dangers of unchecked greed. The collapse of Enron led to a wave of legal and regulatory reforms. The Sarbanes-Oxley Act of 2002 strengthened accounting regulations and increased corporate governance requirements. The PCAOB was created to oversee the audits of public companies. Several key figures at Enron faced criminal charges. Lay and Skilling were both convicted on multiple counts of fraud and conspiracy. Fasto pleaded guilty to wire fraud and cooperated with the government. The Enron scandal served as a harsh lesson in the importance of corporate transparency, ethical leadership, and accountability. The story of Enron is not just a story of corporate greed and malfeasance. It's a story about the failure of systems and the absence of ethical leadership. The Enron scandal should serve as a constant reminder that ethical behavior is essential for the long-term success of any organization. It's a call to action for business leaders, regulators, investors, and all stakeholders to prioritize transparency, accountability, and ethical decision-making. We must remain vigilant, demanding better from our corporations and ourselves. Only then can we prevent the next Enron. The future depends on it. Please subscribe to our channel and like this video if you found it informative.